90% of the world is missing out on the greatest wealth builder in history. I'm currently ahead of almost everyone on earth, not because I'm a genius, but because I started. In the last 2 years, my portfolio is up 70%. If I had to lose it all and start again from zero, today, this is the exact blueprint I would use to build it back. We're going to go through a lot in this video, but I've designed it so by the end, you should have enough knowledge and confidence to get started by yourself. So the first thing we want to do is pick your foundation. The foundation. What your foundation is going to do is follow the broader market, the market as a whole. This will help us stay with the current economic trend, and it is fairly low risk. You have two options and they both involve ETFs. An ETF is a great way to get diversity because they're a big group of companies, stocks, all under one umbrella. And they are liquid, meaning you can buy and sell them just as easily as a single stock. So what are your two options? The first one is the S&P 500 ETF. Now the S&P 500 is an index. It's a group of companies. It's the top 500 companies in America. So think of Apple, Tesla, Microsoft, Coca-Cola, Johnson & Johnson. And the S&P 500 ETF tracks this index. So the top three performing ETFs for the S&P 500 are at the moment Vanguard's S&P 500 ETF, VOO, widely considered the best for long-term investors due to the ultra-low expense ratio of 0.03%. There's iShares Core S&P 500 ETF, IVV, a top competitor to VOO with the same low 0.03% fee and high liquidity. And there's also SPDR S&P 500 ETF Trust, SPY, the oldest and most traded ETF. While the fee is slightly higher at 0.09%, it is the go-to for many institutional traders. There are many more out there, and it's very important that you do your own research and find the one that fits you and your needs. The S&P 500 historically averages around 10 and 12% annually when you invest long term, like 10 years or more. The second option is another ETF, but the world economy. A global economy ETF is going to do much the same as the S&P 500 ETF, but the difference is the S&P 500 has the top 500 companies in America. The global economy ETF includes the whole world. So that gives you a geographical diversification, not only industries and sectors. So the top three performing global economy ETFs currently are Vanguard Total World Stock ETF VT. Tracks over 9,000 stocks globally, covering roughly 98% of the investable world market. Then we have iShares, oh my god, MSCI ACWI ETF, or ACWI for short. It's a bit shorter, I guess. But this ETF focuses on large and mid-cap stocks across 23 developed and 24 emerging markets. Sounds interesting, but you'd probably want to read a little bit more into that. And then you also have the Vanguard FTSE All World ex-US ETF, VEU. If you already own an S&P 500 fund, this is a top choice to get the rest of the world without doubling up on the US stocks. Historically, a global ETF averages around 8 to 10% annually when invested long term. Yeah, not as much as the S&P 500, but the beauty of the global ETF is it will balance out the negative times that the S&P 500 will have. You could pick either the S&P 500 ETF or the global ETF, or both. I would suggest both. And for ease, just go 50-50 on them. If you wanted the fairly hands-off approach, honestly, these two ETFs would do very nicely for you over long term. On average, you could probably expect somewhere between 8 and 12% gains annually. And with those type of gains, you are definitely ahead of 90% of the world's population and finally beating true inflation. So yeah, you can stop the video right here and that's that. But if you want to start outpacing the 10% that already invest, like I do, then you probably want to start doing a little bit more. Now, I just want to be clear, I'm not saying these individual picks are going to give you a 17% return like I saw. That part of the journey depends entirely on your own research and the companies you choose. If doing deep dives into companies' data isn't your thing, it's perfectly fine. You can simply hold those two ETFs that we've talked about, stay consistent, and you'll still build an incredible wealth over time. But if you're like me and want to build on top of your solid foundation, you can pick out a selection of individual stocks to add to your stability and growth. Personally, I like companies, stocks that offer dividends and value. So dividends, that is when a company pays you a part of their profit. And the value I'm looking for is in the stock price and the dividend payments. Do they increase over time? This could be dividend contenders, aristocrats or kings. Now, where would I start? I would look at the companies I buy products from. This is a great place to start because you already know what the companies do and you should believe in them if you're already buying from them. For me, this is where it starts getting exciting. So go around your house, analyse your life, make a list of those companies that you buy from. So I don't know, you might have Apple, Amazon, Coca-Cola, McDonald's, Home Depot, Nike. Whatever they are, it doesn't matter. And the list could be big or it could be small. We're going to pick out the great companies later. For now, you just need to make a list. Pause the video if you need to and make that list. You want to analyse all of these companies in your list. So for example, let's use those companies I mentioned earlier. Instead of spending weeks scrolling through financial reports, use AI like Gemini or ChatGPT to do all the heavy lifting for you. And here's the exact prompt I would use. I'm using Gemini and these are the settings that I like to use. Thinking, it gives me some more in-depth answers than what it would do on just the fast setting. Acting as the financial advisor, take a look at these companies: Apple, Amazon, Coca-Cola, McDonald's, Home Depot, Nike. I want you to tell me which ones pay dividends. From the ones that pay dividends, tell me how many consecutive years they have paid and increased their dividend. Also, for each company, give me a brief description of their business, what their best-selling product is, and what the previous 10 years have been like. Have they been positive or negative? Now, I can leave the full prompt in the description, so you don't need to write it down straight away. It might be quite surprising how many of these companies offer a dividend. So Apple pay a dividend, 14 years of consecutive increases. Coca-Cola with 64 years, dividend king there. McDonald's 49 years, so only one more year and it's a dividend king. You got Nike there as well, one more year away from dividend aristocrat status. Quite impressive really when you think about it. Let's have a look at the company deep dive. So we have Apple here. So the information is quite brief, but it gives you a good picture of what goes on in the company. Last 10 years, extremely positive. Amazon, web services and cloud services, products and general merchandise, 10 years, extremely positive, climbed over 600%. These don't pay a dividend, but they invest every dollar back into growth. And we have Coca-Cola. $500 brands, including sodas, waters and juices. Of course, Coca-Cola Classic is the best-selling product. Steady but positive. McDonald's is actually described as a real estate company that happens to sell burgers. Home Depot there, and Nike. These are all companies that you're a customer of, but now you have a chance to become a part owner and they will give you a slice of their profits. Although past performance isn't an indication of future performance, some of these companies have been increasing their dividends for 25 years to 50 years and even more in Coca-Cola's case. During that time, there has been countless economic downturns. And that tells me that these are strong, reliable companies that have survived economic hardship. Now, I'm not trying to tell you what to do. I'm not a financial advisor and neither is AI. All I want to do is open your eyes to what is out there, and AI is a very powerful tool for research. Of course, it's you that makes the final decision. If you're going to invest your money into a company, why wouldn't you invest in a company that has a very good track record, pays you a percentage of their profits, and you're already a customer? Using AI, you could start diving deeper into your research, start with one company, and then move on to the next. You could ask, how long has the current management team been active and working together for? How stable is the cash flow? Is there any hidden debt within the company? You can ask about the 10K annual report. What are the company's predictions for the next 5 or 10 years? Your options are endless with AI. So now you probably have a handful of companies that you have done your research on, but you're thinking, how much do I buy? Do I buy one? Do I buy them all? You have diversification from your foundation, and you want to still have your diversification in your individual stocks. So split up your selected companies that have passed the grade into their sectors and industries. Here we have 3 main sectors, but luckily all of the companies have their own industry. A quick pro tip, check out the ex-dividend dates for these companies. The ex-dividend date is the date you need to own a share or fraction of a share by to receive the next dividend payment. So try and time it so you get the next dividend payment. That dividend payment is going to boost your motivation and will increase your next month's contribution. Now here comes the tricky part, because everyone is different. Their contribution, their risk and their comfort level. But a good place to start would be around 60% of your contribution to your foundation and around 40% towards your individual dividend stocks. If you want more safety, do 70% on your foundation and 30% on your individual dividend stocks. Now you want to be buying at a reasonable amount for each stock, but keeping some diversification. So you need to look at the price of the stocks, what you have to spend on the stocks, and kind of work that out for yourself. But 2 to 3 stocks is a good place to start. Even 1 if that's what your budget is. Picking the ones with the ex-dividend date so you get your first dividend a month or 2 later. And to keep the diversification, pick stocks from different sectors or industries. So let's recap. You first pick your foundation. 1 or 2 of the ETFs evenly divided. If you want to build the growth layer, use 60% of your contribution for the foundation or 70% if you want more safety. For the growth layer, you make a list of the companies of products and services that you use. Using AI, you do some quick research, finding out the dividend payers, highlighting the aristocrats and the kings. You do a deeper research to really understand how the company works and how it truly makes the profit and the free cash flow. You do this for each and every company that is still in your list. With the handful of companies you have left, you split them into their own sectors and industries. After checking the ex-dividend dates, you purchase 1, 2 or 3 companies, using the remaining 40 or 30% of your contribution. When I first started, I would buy either shares or fractions of shares in 2 companies with $50, $25 in each company. When I had about 10 different companies in my portfolio, then I started to be more interested whether I was paying a good price, a high price or a fair price for that slice of the excellent company. To understand that more, we would need to look into the intrinsic value, but that does need its own video to explain that. I will be making that video soon, or if you're watching this later in the year, check out the beginner series, it could already be out. Over time, I have added companies to my portfolio. I currently have 27 companies, and I would say between 20 and 30 companies in a portfolio for a personal individual investor is about right. Any more than 30, it will become hard to manage and keep track of all of the companies. But now you should have a good understanding on how to get started. If you want to be successful at this, you will need to do your own research and understand the risks and how to manage them. When you have the knowledge, then you have the power to control your emotions. If one of your stocks goes down by 10 or 15%, and they do sometimes, you're going to be able to trust your research, your knowledge, and your decisions to keep your emotions in check, because if you don't, there's every chance you'll start selling in the red and buying in the green, losing wealth instead of building it. I'm not trying to scare you, but this is the reality, and it happens to lots of people trying to make quick money. You can learn this just like I did. Check out my portfolio update series every month from the beginning. I share it all. Like I said, there is also the beginner series. I'm also on Facebook and Instagram. I'll put the links in the description along with some freebie links. If you have any questions, feel free to DM me on Instagram or Facebook. I'm Steve Williams and I've been the Dividend Dad.